In today's ever-evolving financial landscape, where the latest headlines often depict a world of rapid economic shifts and unprecedented market volatility, the quest for wealth remains a universal constant. Amidst this backdrop, the story of Warren Buffett, the Oracle of Omaha, stands out as a beacon of wisdom and a masterclass in the art of investing. With a net worth that's a testament to his strategies, Buffett isn't just an investor. He's a legend whose methods have turned the dream of riches into reality for many. Now, let's dive into the heart of what makes Buffett's approach so revolutionary, especially in the context of 2024. Consider this. Despite the economic turbulence marked by fluctuating interest rates and the tech sector's roller coaster ride, the S&P 500 has continued its long-term upward trajectory, echoing Buffett's belief in the resilience of the American economy. This isn't just about big numbers and corporate giants. It's about how you, sitting at home with your investment portfolio, can navigate these waters with the same acumen as Buffett. Imagine you're holding two stocks, one from a company you use daily, understand deeply, and believe in its long-term value. The other, a speculative bet on a trend you heard might skyrocket. Buffett's golden rule: invest in what you know, has never been more pertinent. In a world where meme stocks can momentarily soar and crash, grounding your investments in solid, understandable businesses is like choosing a sturdy ship in the stormy sea of the market. This introduction isn't just about admiring a billionaire's success from afar. It's about bringing those strategies into your living room, your finances, and your future plans. It's about making the art of getting rich not just a possibility, but a practical part of your daily life, with Buffett's wisdom as our guide. Let's embark on this journey together, turning wisdom into wealth in the most personal sense. 1. Invest in what you know. Warren Buffett's first rule is more than just advice. It's a principle that guides savvy investors through the complexities of the market, ensuring they make informed decisions based on familiarity and understanding. In a world where technology stocks can surge and plummet within the same fiscal quarter, and new investment platforms offer access to global markets with a tap on a screen, this rule grounds us in a strategy that withstands the test of time. Consider the rise of electric vehicles, EVs, and renewable energy sectors. These industries have seen exponential growth, with the global electric car stock reaching over 10 million vehicles, according to the International Energy Agency. For someone with a passion for sustainability and a keen interest in technological advancements, investing in companies within these sectors could align well with Buffett's principle. It's not just about the potential financial return. It's about understanding the products, the market dynamics, and believing in the sector's long-term impact on the world. But here's the kicker. Investing in what you know doesn't mean you should put all your eggs in one basket. Diversification is still key. For instance, if you're well-versed in technology, while it's tempting to invest solely in tech stocks, it's crucial to balance your portfolio with investments in other sectors you're familiar with, or seek out mutual funds that provide a wider exposure. This approach to investing isn't just about playing it safe. It's about playing it smart. By focusing on industries and companies you understand, you reduce the risk of unexpected downturns that could affect your investments. It's a strategy that encourages continuous learning and engagement with your investments, making the investment process not just profitable, but also personally rewarding. In essence, invest in what you know transforms the daunting task of navigating the financial markets into a journey of personal and financial growth. It's a reminder that in the world of investing, knowledge is not just power, it's profit. 2. The power of compound interest. The magic of compound interest, often hailed as the eighth wonder of the world by financial enthusiasts, is a principle that Warren Buffett attributes much of his success to. This concept isn't just a mathematical curiosity. It's the backbone of wise investing, turning modest savings into vast fortunes over time. Compound interest works by earning interest on your interest, creating a snowball effect that accelerates the growth of your investment. Let's break this down with a real-life scenario that speaks directly to the power of starting early and staying consistent. Imagine you're 25 years old and you decide to invest $5,000 annually in a retirement account with an average annual return of 7%. By the time you reach 65, without ever increasing your yearly contribution, your initial investment of $200,000 will have grown to over $1 million. This example isn't just theoretical. According to a report from the Federal Reserve, the average retirement account balance varies significantly by age, with individuals closer to retirement age showing exponentially larger balances, underscoring the cumulative power of compound interest over time. The beauty of compound interest lies in its simplicity and accessibility. Whether you're investing in stocks, bonds, or a retirement account, the principle remains the same. The sooner you start, the more you benefit. This isn't about having a large sum of money to begin with. It's about making your money work for you over time, turning patience and consistency into your greatest financial allies. In today's financial landscape, where interest rates and market dynamics are constantly shifting, understanding and leveraging compound interest can be a game changer for your personal finance journey. 3. Value investing over speculation. In the fast-paced world of investing, where headlines often out the overnight successes of speculative bets, Warren Buffett's steadfast commitment to value investing shines as a beacon of rationality and long-term thinking. Value investing, the strategy of selecting stocks that appear underpriced by some form of fundamental analysis, has been Buffett's North Star, guiding him through decades of market ups and downs. Let's consider a tangible example that illustrates the essence of value investing in today's context. Imagine a company like XYZ Corporation, which operates in the renewable energy sector. Despite its solid fundamentals, including consistent revenue growth and a strong balance sheet, XYZ's stock price takes a temporary hit due to a market-wide sell-off. To a value investor, this scenario presents not a warning, but an opportunity, a chance to purchase shares of a fundamentally sound company at a discount. Recent data underscores the effectiveness of this approach. Studies have shown that over long periods, value stocks have outperformed growth stocks in various markets. For instance, a report by Bank of America Merrill Lynch highlighted that, over a 90-year span, value stocks have returned an average of 17% per year, compared to 12.6% for growth stocks. Buffett's success with value investing isn't about catching the next big thing. It's about recognizing the intrinsic worth of a business and its potential for steady, long-term growth. This principle encourages us to look beyond short-term market trends and focus on the fundamentals, ensuring that our investment decisions are grounded in reality rather than speculation. For individual investors, embracing value investing means doing your homework, researching companies, understanding their business models, and evaluating their financial health. It's a method that champions patience, diligence, and a focus on long-term gains, offering a counterpoint to the volatile, often speculative nature of today's markets. In essence, value investing is not just a strategy. 4. The margin of safety. The concept of the margin of safety, a cornerstone of Warren Buffett's investment philosophy, serves as a critical buffer against the uncertainties of the market. This principle involves investing at a price significantly below your estimation of the intrinsic value of an asset, providing a safety net against errors in judgment or enforcing market downturns. Let's apply this concept to a scenario that's all too common in today's market. Consider a tech company, Touch Innovate, known for its strong fundamentals, including robust earnings growth and a solid market position. Despite its strengths, the company's stock experiences a significant drop due to a temporary industry-wide slump. Here, the margin of safety would be the difference between your calculated intrinsic value of Touch Innovate stock, based on its fundamentals, and its current lower market price. This gap represents not just a discount, but a cushion against potential losses, making it an attractive buy for the value investor. Recent market data reinforces the wisdom of this approach. For instance, during the market volatility experienced in recent years, sectors that traditionally have offered a higher margin of safety, such as utilities and consumer staples, have often outperformed more speculative sectors during downturns. This trend highlights how stocks purchased at a margin of safety can provide more stability and potential for rebound. For personal finance, the margin of safety concept translates into a strategy of cautious optimism. It encourages investors to seek out undervalued opportunities while being mindful of the risks. This approach doesn't just mitigate potential financial losses. It also instills a discipline of rigorous analysis and patience, ensuring that investment decisions are made with a clear head rather than being swayed by market euphoria or panic. In a nutshell, embracing the margin of safety is about making investment choices that offer a buffer against the unpredictable nature of the markets, aligning closely with Buffett's philosophy of looking for value with an added layer of protection. 5. Market fluctuations are opportunities. Warren Buffett famously views market fluctuations not as obstacles, but as opportunities. This perspective is especially relevant in today's financial climate, characterized by rapid changes and unpredictability. For individual investors, understanding and embracing this mindset can transform the way they approach their personal finance strategies. Consider the recent global events that have led to significant market volatility. For instance, during the initial months of the COVID-19 pandemic, the stock market experienced dramatic drops, only to rebound to new heights thereafter. While many investors panicked and sold off their holdings, those who viewed the downturn as a buying opportunity, acting in the spirit of Buffett's philosophy, were able to capitalize on the lower prices to enhance their portfolio's long-term value. Real-life scenarios further illustrate this principle. Take Jane, a casual investor, who decided to invest in a well-established tech company after its stock price dropped due to a temporary setback. By purchasing shares when the market was low, Jane was able to secure a significant position at a discounted rate. As the market stabilized and the company's stock price recovered, the value of Jane's investment grew substantially, demonstrating how market fluctuations can indeed be opportunities for those prepared to act on them. Recent statistical data supports the advantage of this approach. Historical market trends show that periods following significant downturns often experience robust recoveries. According to a study by Fidelity Investments, markets have typically returned an average of 32% in the year following a market bottom. By viewing market fluctuations through Buffett's lens, individual investors can learn to see beyond the immediate turbulence and identify potential for growth where others see risk. 6. Be greedy when others are fearful. Warren Buffett's adage, "Be greedy when others are fearful," is a powerful call to action that encourages investors to zig when the market sags. This contrarian approach can be particularly effective during times of market distress, when widespread pessimism often leads to undervalued investment opportunities. For a real-world application of this principle, let's consider the recent market dynamics. During significant market downturns, like the one triggered by the COVID-19 pandemic in early 2020, the S&P 500 plunged by over 30% in a matter of weeks. Yet, those who followed Buffett's advice and invested during these periods of fear saw the index rebound to unprecedented highs by the end of the year, demonstrating the potential rewards of contrarian investing strategies. Another illustrative example can be found in the energy sector's volatility in recent years. Investors who were bold enough to invest in quality energy stocks during the 2020 oil price crash, when the sector was largely out of favor, would have seen considerable gains as the market recovered and oil prices surged in the following months. Recent statistical data underlines the effectiveness of this approach. A study by J.P. Morgan Asset Management highlighted that investors who stayed in the market between 1995 and 2014, despite the volatility, would have earned a 9.85% annual return, compared to only 5.1% for those who missed the 10 best days of market performance. Buffett's strategy of being greedy when others are fearful isn't about taking unnecessary risks. It's about recognizing that market overreactions can present buying opportunities for undervalued assets. 7. The long-term perspective. Embracing a long-term perspective is a hallmark of Warren Buffett's investment philosophy. This approach transcends the daily noise of the market, focusing instead on the underlying value and growth potential of investments over years or even decades. This strategy is not just about patience, it's about understanding that true wealth is built over time, through the compounding of gains and the resilience to withstand market fluctuations. Consider the remarkable growth of the tech industry over the past 2 decades. Investors who recognize the long-term potential of companies like Amazon and Apple, and held onto their investments through various market cycles, have seen exponential returns. For instance, a $1,000 investment in Amazon at its IPO in 1997 would be worth well over $1 million today. This example underscores the power of a long-term outlook, where the focus is on the company's potential to disrupt industries and grow its market share over time, rather than short-term price movements. Recent studies support the benefits of long-term investing. Research by Vanguard found that investors who maintain a long-term perspective are more likely to achieve their financial goals. The study highlights that a diversified portfolio held over a 10-year period had a 92% chance of outperforming cash investments, illustrating the reduced risk and increased potential for returns that comes with a longer investment horizon. Adopting a long-term perspective means resisting the temptation to react to short-term market volatility. It's about staying the course, even when headlines suggest turmoil. Now, if you want to learn how to achieve financial success, then watch this video next. And if you made it to this point of the video, please like and subscribe to the channel to see more content like this. Thanks for watching, and I'll see you in the next video.